identified one more thing, that if the correlation coefficient is zero, so if the correlation coefficient is zero, the portfolio risk is nil if the securities are related negatively. So this indicates that the risk can be eliminated if the securities are perfectly negatively correlated, right? So the standard deviation of the portfolio is sensitive to the proportion of funds devoted to each stock, as well as the standard deviation of each security and the covariance between the two stocks. So having a basic idea of that, today we will go for the next problem. Yeah, students, can you see the screen?
Yes, sir.
Yeah, perfect. So before going, as we know, we'll just see how about the market's condition today, right? So what was the opening and who are the top gainers for the day? We'll just have a glance of that, then immediately we'll go for the next problem. So today you can see markets, it is up by 107 points, and Sensex, a lot of people are using online classes, so probably for that the net is slow. Okay, Sensex is 44,427, that is, it is up by 350 points almost, you can see here at the top. And NSE is concerned, it is 13,033.8, it is up by 107.35. So let me see who are the top gainers for the day. So the top gainers are Tata Motors, Eicher Motors, Maruti, and M&M and Adani Ports. Where the top losers for the day are concerned, Gas Authorities India Limited, that is GAIL, ONGC, Oil and Natural Gas Corporation, HDFC Life, Reliance, and IOC. So these are some of the top gainers and top losers for the day. Well, today is concerned, we have opening. The opening of the market is very bullish. So opening itself is 350 points up. So I think more and more foreign institutional investors are investing in Indian equity market. Probably for the next 3 years is concerned, students, India will become one of the favorite equity market globally. So a lot of investments are coming to Indian equity market. So probably that might be the reason. So we can expect a good bull run for the next 3 years are concerned. As you are aware, all the companies globally, they are planning to invest directly in Indian soil as well as in Indian secondary market. So probably that might be the reason. The confidence now with the Indian companies as well as the confidence with the Indian political system has made globally all the companies to invest in Indian soil. So probably that might be the reason the markets are up today. So it's a fantastic opening today, both NSE and BSE. Now we'll go for today's session. Students, can you see the screen? Can anyone reply yes, sir? Am I audible to you?
Yes, sir.
Yes, sir.
Perfect. Okay. So today we'll go for the problem 2. Please understand the problem. First, we'll understand the problem, then we'll go for the solving of this particular problem. So the first problem for the day and the second problem for this particular unit. Stocks L and M have yielded the following returns for the past 2 years. So they have given 2 stocks here. The name of the stock is L and the name of the second stock is M. So years also they have mentioned. In the first year it is 12 and 14, and in the second year it is 18 and 12. Now what we are expected to calculate from this particular data, they have mentioned in 4 parts. And students, this problem every alternate year they have asked in the question paper. I'm repeating, this problem every alternate year they have asked in the question paper. Okay. Now they've asked me, what is the expected return on the portfolio made up of 60% of L and 40% of M? So they have given me the proportion of funds that will be invested in L, that is 60%, and the proportion of funds that will be invested in M, that is 40%. And we have to find out the standard deviation of each stock. And the C part is what is the variance and coefficient of correlation that exists between L and M? And the D part is what is the portfolio risk? Can anybody tell me symbolically how do we say portfolio risk? Sigma P. Please understand sigma P, okay, of a portfolio made up of 60% of L and 40% of M. See, they can give me any proportion, students. It can be 50% of L and 50% of M, or it can be 80% of L, 20% of M. Okay, so it 90% of L and 10% of M. So the total proportion should be how much? 100%. Okay. Now we will solve step by step so that we can understand this problem. It is a very simple problem. So we will go for the solution of this particular problem. Yeah, the first step. First, we'll calculate the expected rate of return. So how do we calculate the expected rate of return? It is summation of R divided by N. Now, first we will take return of stock L, which is equal to 12 plus 18 divided by 2. So which is equal to how much? 15. Similarly, for stock M, 14. So how I am getting this value? They have given me, right? So 14 plus 12 divided by 2, which is equal to how much? 13. So first what I'm solving, students, I'm solving the expected rate of return, summation of R divided by N. Then I will calculate the portfolio return. That is very important. So portfolio return is how do we calculate? It is summation of I is equal to 1 to N. X1. X1 is what? Can anyone tell me what is X over there? X. Here where my cursor is there. What is X here? 1 minute, sorry. Here. What is X? Anybody? What is R?
So 60% and 40%, that is the X. The proportion.
What is that? X is called 60 and 40. What is
the
that?
proportion, sir.
Very
The
good.
percentage.
The proportion of funds that will be invested in stock L and M. Students, some of you are sleeping. Please understand it is a very important problem. Okay. X is the proportion of funds that will be invested. See here in the problem they have given A part. What is the expected return of the portfolio made up of 60% of L and 40% of M? So this I'm solving now. Okay. So X being the proportion held by each security, which includes 60% of L and 40% of M. So what I say, 60%, that is 0.6 into, it has to be into, students, please understand, 0.6 into 15 plus 0.4 into 13. I'm repeating, 0.6 into 15 plus 0.4 into 13. Please solve, all of you. Yes. What is the value you are getting?
So 14.2.
Wait, what about others, man? Others are, what about others? There is, hello, 38 students are there today, but only one is answering. How about others?
14.8.
Sir, 14.2.
Ranjit, how come
14.2?
14.8 you will get? It should be 14.2. Please check it, Ranjit.
Okay,
See?
sir.
No, once you check, don't say, okay, 0.6 multiplied by 15 is how much? 9. So 0.4 multiplied by 13 is how much? 5.2.
Yes, I
So,
got, sir. 14.2.
14.2. Others all are getting?
Yes, sir.
Perfect. Okay. So you should be shouting in IM class with the answers. Don't sleep now. Come on. The next part, standard deviation of each stock. How do I calculate the standard deviation of each stock? Sigma. The symbolically standard deviation means sigma. Sigma is equal to square root of summation of R1 minus R1 bar whole square divided by N. Now see my cursor here. R1 means what? That is 12 minus 15 whole square plus 18 minus 15 whole square divided by 2, which is equal to square root of 9 plus 9 divided by 2. Similarly, you all calculate for standard deviation of m and tell me the value. Though the value is there, but you tell. Sometimes it so happens that it will be a wrong value here. So I want everybody to solve using the scientific calculator and tell me the value, okay? So first I'll solve this. 12 minus 15 whole square. 12 minus 15 square, which is equal to 9. 18 minus 15 square, which is equal to 9. So square root of 9 plus 9 divided by 2 is how much? 18 divided by 2. 2 ones are 2 nines are. Square root of 9 is how much? 3.
3.
So standard deviation of security L is how much? 3. Similarly, all of you solve for standard deviation of security M and tell me. Don't simply
So
copy here.
1, sir.
So is it correct?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Let others solve. I'll go to the next part of the problem now, C part. So all of you understood. Ranjit, what we solved in the first part,
Sir, expected return, sir.
and then in the second part.
Standard deviation of each stock, sir.
Now, Ranjit, you tell me which stock is risky.
Sir, stock M, sir.
Stock M is risky.
Yes, sir.
See properly.
Stock L, sir. L is risky. The
Why?
stock standard deviation is high, sir.
Yes, sir. Standard deviation is high of L.
Then I'll now put you, if you were in the class here, I would have thrown you out of the class. Huh? You should concentrate. So I'll be asking you.
Yes, sir.
If the standard deviation of the security, if it is high, that means it is risky. Correct?
Yes, sir.
Okay. Now, the C part. All of you are with me, students? How
Yes,
many are there
sir.
today? Let me see. Wait. 36 students are there. Okay. Now the next part. The C part is concerned. I'll go for the C part. The covariance between stock L and M. So how do we calculate the covariance of L and M? Covariance of LM is equal to summation of R1 minus R1 bar, that is RL, into RM minus RM bar divided by N. For your understanding, I have done the calculation here. So 12 minus 15 into 14 minus 13 plus 18 minus 15 into 12 minus 13 whole divided by how many securities are there? 2 securities are there, right? Please understand this, what I'm solving now. Covariance that exists between L and M. And why I am calculating covariance? Because I need to find correlation coefficient. For this, I require covariance first. So for that sake, I am solving covariance that exists between the stock L and M. So covariance of LM is equal to, please see here, 12 minus 15 into 14 minus 13 plus 18 minus 15 into 12 minus 13 whole divided by 2. So minus 3 into 1 is how much? Minus 3. 3 into minus 1 is how much? Minus 3 divided by 2. So minus 3 is how much? Minus 6
Minus 6.
divided by 2, which is equal to minus 3. I'll till here everyone has understood. Don't get confused here. Minus, when we are doing minus 3, the sign remains the same, minus 6 divided by 2. If it was minus 3 into minus 3, then what was the answer? Minus 3 into minus 3.
Plus 6, sir.
Hey,
Plus
again.
9, sir. Plus 9, sir.
MBA students are telling wrong answer. You should be, so, okay. So minus 3 plus of minus 3. So it is minus 6 divided by 2, which is equal to minus 3. So till here everyone has understood. I will go for the next part now. Calculation of correlation coefficient. So how do we calculate correlation coefficient? R, the symbol used is R. So covariance of security LM divided by standard deviation of L into standard deviation of M, that is security M. So what is covariance? Covariance of LM? Just now I have calculated, that is -3 divided by, from where I got the standard deviation of L and M. See here, I have solved here. Standard deviation of L is how much? 3. Similarly, standard deviation of M is how much? 1. So in the denominator, it is 3 into 1, which is equal to -1. Students, please understand, whenever I am referring here, it is called as numerator and this is called as denominator. Okay. So in division, this is called as numerator, this upper part, and the lower part is called as denominator. So covariance of LM is -3 divided by 3 into 1, which is equal to how much I got correlation coefficient? -1. That means, what is the inference from here? If they are negatively correlated, then what happens to the standard deviation? We will solve the standard deviation of the portfolio. Okay. Sigma p is equal to square root of, please remember this, a plus b whole square, a square plus b square plus 2ab. Similarly, x1 square into standard deviation of L square plus x2 square, standard deviation of the security 2 square plus 2 into x1 x2, correlation coefficient that exists between the two securities into standard deviation of 1 into standard deviation of security 2. So sigma p is equal to how much? Square root of what they have given me in the problem. Let me go for the problem now. See, what is the portfolio risk, which is made up of 60% of L and 40% of M. So the same thing I will apply here. What I'll do? 0.6 square multiplied by 9 plus, this is 60%. Now 40%, 0.4 square into 1 plus 2 into 0.6 into 0.4, this is 60 and 40, multiplied by 3 into 1 into -1. So what is this correlation coefficient? -1. Standard deviation of security 1 is 3. Standard deviation of security 2 is 1. So which is equal to 3.24. I request all of you to solve. Simply do not keep on seeing the slide over there. I request everybody to solve, okay? And update me whether you are getting the same answer. Please solve, students. Let me know whether you are getting 1.4.
Yes, sir, same answer.
Okay. Others?
Yes, sir. 1.4, sir.
Okay. Nisarg, Padmaja, Praniksha.
Yes, sir. 1.4.
Okay. Rupa Paramgond.
Yes, sir. 1.4.
Sabia, are you there? Someone who has kept the mobile and gone somewhere to have breakfast? Sabia? See, Sabia, she has kept it and went for breakfast. Sabia Kittur. Sakshi?
1.4, sir.
Okay. Sariga Kumar. Sariga Idiga? Yeah, Sariga Kumar. I can hear you. Okay.
Yes, sir.
Perfect. Steven?
Yes, sir.
Okay. Vani Poddar? Oh, okay. So till here everyone has understood. Shall we go for the next problem? So what we have solved here in this problem. So first I'm repeating now. First we have calculated expected rate of return of security L and M, and then we have calculated the standard deviation of each stock. And in the third part, we have calculated the covariance first. And whatever value we have got here, the covariance is concerned, we have applied here to get the correlation coefficient that exists between security L and M. Then finally, we have calculated the standard deviation of the portfolio, right? So we got the standard deviation of the portfolio to be equal to 1.4. Clear? Next, we will go to the problem number 3. 1 minute, students. We'll just drink water. Students, I want you to solve this problem. Stock Y and Z have the following parameters. So what they have given me? Two stocks, stock Y and stock Z. So they have already given me the expected return, that is 20 and 30. They have even given me expected variance also. How much? 16 and 25. They have given me one more parameter that is called as covariance that exists between the stock Y and Z, that is equal to 20. Now, what they have asked me is there any advantage of holding the combination of Y and Z? That means if the investor holds the two securities in his portfolio, so is there any advantage for that? So what we have to do, he has asked me to calculate the standard deviation of Y and Z, and then he has asked me to calculate the correlation that exists between the stock Y and Z. So can you people solve and tell me the values? Everything is there. In 2 steps, you have to get the answer. Okay, first, calculation of standard deviation. Since they have already given me variance, students, standard deviation of Y is how much?
4, sir.
Who told 4? Who is this?
Sir, Kedar.
Students, is it correct? Please interact. They have given me expected return, they have given expected variance, then they have given covariance. Now, the first part, they have asked me to calculate the standard deviation of Y and Z. So, standard deviation of Y, Kedar is telling 4. Is that correct?
Yes, sir.
And what is the
So,
standard
4,
deviation of
7.
Z?
5, sir.
That's all. Okay. All of you see here. Standard deviation of stock Y is square root of 16, which is equal to 4. Then similarly, standard deviation of stock Z is square root of 25. It has to be. Sorry, it has become 5 over there. In the problem, they have given me how much here? You can see my cursor. They have given me 25. So it has to be here 25. Square root of 25, which is equal to 5. The B part, we have to calculate the correlation coefficient that exists between two stocks, that is Y and Z. So how do we calculate the correlation coefficient? It is covariance that exists between stock Y and Z divided by standard deviation of Y into standard deviation of Z. Now, what is covariance? They have given already. The covariance of stock Y and Z is how much? 20. In the problem they have given. So, what will come in the numerator then? 20 divided by standard deviation of Y. We have calculated 4 into 5, which is equal to 20 in the numerator divided by 4 5s are 20, which is equal to plus 1. No, plus 1. That means they are positively correlated. Which all? That is stock Y and Z are positively correlated. So, if the two securities are positively correlated, there is no advantage of holding a combination of Y and Z, as the risk cannot be reduced because they are perfectly positively correlated. Okay, so yesterday we solved one problem wherein the two securities were negatively correlated, right? That is -1. In that case, the risk can be reduced, the portfolio risk can be reduced. But please remember this, students, If the two securities are positively correlated, there is no advantage of holding the stock Y and Z in the portfolio, as the risk cannot be reduced because they are perfectly positively correlated. See here, +1. Done. Sometimes students get confused. The same problem they had asked in the previous question paper, they were finding it difficult to calculate correlation coefficient only. So I have taken some of the problems from the earlier paper only. Okay, correlation coefficient, they, sir, where they have given covariance, sir. Here itself they have given no 20. Covariance of YZ is 20. Okay, so directly apply the 20 to the numerator here, divided by 4 into 5, which is equal to +1. It's very easy problem. Okay, but you need to first read the problem, understand what they have given, and based on that you can start your calculation. So shall we go to the next problem? Okay, problem number 4. The expected rate of return and the possibilities of their occurrence for alpha company and beta company scripts are given below. Okay, so there are two companies, or the two scripts what they have given, that is alpha and beta company, and the probability of their occurrence also they have given. There are 3 columns. First column, alpha script, and the third column is written on beta script. 1 minute, students. Okay. Now what they have asked me to calculate, see here, A part, find out the expected rate of return for both the scripts, that is alpha as well as beta. Now B part is concerned, if an investor invests equal proportion on both the scripts, what would be the return? Now can anyone tell me equal proportion means how much? Two scripts are there. Equal proportion is mentioning. How much?
50%, 0.5.
Very good. 50% in alpha script and 50% in beta script. So in the problem while calculating, we have to take how much? 0.5 and 0.5. Now suppose if there are 4 scripts, please understand my question. Suppose if there are 4 scripts and if he says equal proportion should be invested, what will you take?
So 25%.
Very good, very good. 0.25, 0.25, 0.25 and 0.25. Okay, please understand that. Now the C part is concerned, if the proportion is changed to 25% and 75%, and then 75% and 25%, what would be the rate of return? So first we have to calculate for 25, 75, and then we have to calculate for 75 and 25. Okay, so we will go for the solution for this problem now. So first what we have to calculate? First we have to calculate the return on alpha script. So since the probability of occurrence, there are 5 values. So what I'll do is, I'll use this. That is summation of I is equal to 1 to n, R1 into P1. That is probability of occurrence. So what I do, how do I calculate? Sorry. R1, that is return 1 into probability 1 plus R2 P2 plus R3 P3 plus R4 P4 plus R5 P5. Now see your table, students, all of you. So what I'll do here, -2. Please see my cursor, -2 into 0.05 plus 9 into 0.2 plus 12 into 0.5 plus 15 into 0.2 plus 26 into 0.05. Okay, so in the same way I'll calculate. All of you please solve for return on alpha scripts and return on beta scripts and tell me whether you are getting the same value. I request all of you to use your calculator so that your calculation will become fast in the examination. Yes. Students,
Sir, 12 and 10.43.
12 and 10.43.
10.43. Yes, sir.
Okay, perfect. Any other student? 12 is perfect. 10.43. Okay, let me solve here. Minus 3 multiplied by 0.05. I'll plus 6 multiplied by zero point 0.2 plus 11 multiplied by 0.5 plus 14 multiplied by 0.2 plus 19 multiplied by 0.05. It has to be exactly 10.3 ma. Even if you are getting 10 point some other value, no problem. But
Yes,
just
sir.
try to check once.
Yes, sir.
Yeah, all others
12 and 10.3, sir.
perfect. Twelve and 10.3. Okay. Now, after solving the return on alpha scripts and return on beta scripts, I'll go for the B part. Now, if an investor invests equal proportion, that is 50%, then portfolio return RP, you can see here RP. How do I calculate? Summation of I is equal to 1 to n. P is what? Probability of occurrence multiplied by R1. So first I'll take for alpha script, RP is equal to 0.5 multiplied by 12 plus 0.5 multiplied by 10.3. How do I get 0.5 multiplied by 12? Okay, plus 0.5 multiplied by 10.3. I got the portfolio return to be equal to 11.15 when the proportion of funds invested is equally in both the securities. It is equal. So when it is mentioned equal, when two securities are there, it is obviously how much? 50% and 50%. So 0.5 multiplied by 12 plus 0.5 multiplied by 10.3, I get the value to be equal to 11.15. Now what he has asked me is C part. See, all of you in the C part, if the proportion is changed to 25% and 75% and then to 75% and 25%, what would be the expected rate of return? Now first let me solve 75% of alpha and 25% of beta. So RP portfolio return is equal to 0.75 multiplied by 12 plus 0.25 multiplied by 10.3. I get the value to be equal to 11.575. What I'm doing here, 75% means what? 0.75. 25% means what? 0.25. Okay. Similarly, I get the value 25% of alpha and 75% of beta. So what I do, 0.25 multiplied by 12 plus 0.75 multiplied by 10.3. I get the value, that is portfolio return RP is equal to how much? 10.725. So please calculate and tell me the values are perfect, all of you. Then only I'll take you to the next problem.
Yes, sir.
Yes, sir.
Only few are there. How about others? Others? Hello? Divya Patil?
Yes, sir.
Okay. Energy is not there. Huh? Sunday. Sorry, Tuesday morning. Vishal is there shouting. Snehal. Snehal.
Yes, sir.
Okay, ma. Sia Parab. Good morning.
Good morning, sir.
You are solving with me?
Yes, sir.
Perfect. Okay. Oh. Prashant. The moment I called his name, he left the meeting only, huh? Okay, no, he'll join again. Okay, we'll go for the next problem now. Okay, problem number 5. A financial analyst is analyzing two investment alternatives, Z and Y. Someone has, yeah. Who is this?
Sir, Sadiga, sir.
Yes, ma. Please tell me.
So the RP, that is the other one, sir. 0.5 into 10.3 multiplied by 10.3, sir. The answer comes 51.5, no, sir.
Which one, ma? Which one?
The previous sum, sir.
No, yeah, it is there. It is the C part you are telling. C part.
Yes,
What you
sir.
are seeing in the slide, the same problem.
Yes, sir.
Okay. Now you are telling about 75% of alpha and 25% of beta, or you are speaking about 25% of
B part, sir. B part.
B part.
If
Okay.
an investor invests equal proportions.
Okay.
So
1 minute.
0.5 multiplied by 10.3, sir.
Okay.
The
It is
answer is
5.15. Correct. 0.5 multiplied by 10.3 is 5.15. It is correct. Please solve once again, ma.
okay, sir.
No. You solve and tell me. I want the answer from you. You should say yes, sir. Please
Yes, sir.
solve.
Yes, sir. I calculated wrong, sir. Sorry, sir.
No problem. Okay.
Thank you,
Done.
sir.
Shall we go for the next problem?
Yes, sir. Yes, sir.
Perfect. Now, what they have given me, they have given me rate two securities and the probability of occurrence. Determine each alternative expected rate of return, variance, and standard deviation. Is Y comparatively riskless? If the financial analyst wishes to invest half in Z and another half in Y, would it reduce the risk? When he is telling half means how much? 50% in Z and 50% in Y. Explain the reason for it he has mentioned, right? So first what we'll do, we'll solve the A part. A part, that is expected rate of return. So Ry bar is equal to summation of I is equal to 1 to n R1 into P1. All of you can see here how I am solving. Let me see. 22 multiplied by how much? 0.2 plus 14 multiplied by how much? 0.6 plus of minus 4 multiplied by 0.2. All are with me. In the same way, I'm solving the expected. See here, 22 multiplied by 0.2, 0.6 multiplied by 14 plus 0.2 multiplied by minus 4. So I get the value to be equal to 12. All of you, please solve this. Similarly, till here you solve. That is expected return of security Z. I should get the value to be equal to 15. Please solve till here, all of you. See the table and solve. I'll not give the solution. All of you first solve the expected rate of return and tell me the value for both the securities, RY and Y and Z.
Sir, stock wide 12, sir.
Stock wise 12. Okay,
12 and
perfect.
15, sir.
15, sir. 12 and 15.
Perfect.
12 and 15, sir.
Okay. Okay, let me see the value now. Perfect, 12 and 15. Those who have solved can solve the next part also. The next part. You have to just calculate the standard deviation of the portfolio. 1 minute, the slide is stuck. Now, so as you people mentioned, it is 12 and 15, okay? The next thing is, what he has asked me, the variance he has asked me, right? So sigma y square is what? Variance, which is equal to 22 minus 12 square multiplied by 0.2 plus 14 minus 12 whole square multiplied by 0.6 plus minus 4 minus 12 whole square multiplied by 0.2. Students, please remember they have given me the probability also. So even if you miss this probability, you will get the wrong answer. So while calculating the variance of y, you should be very careful, okay? So 22 minus 12 whole square multiplied by 0.2, you can see the probability here, 0.2, 0.6 and 0.2, okay? 14 minus 12 whole square multiplied by 0.6 plus, sorry, minus 4 minus 12 whole square multiplied by 0.2. I got the value to be equal to 73.6. What is this 73.6? It is the variance of security Y. Similarly, variance of security Z. All of you, please solve 5 minus 15 whole square multiplied by probability, that is 0.2, plus 15 minus 15 whole square. Here, this part will become 0, students. Plus 15 and minus 15, it is 0. Plus 25 minus 15 whole square multiplied by 0.2. Then after calculating the standard deviation of Y and Z, I'll calculate the variance of Y and Z. I'll calculate the standard deviation of Y and Z. So standard deviation of Y is 8.6 and standard deviation of Z is 6.32. All of you solve till here and verify the answer. Till here, till standard deviation of Y and Z. First step is you have to calculate the variance, and the second step is you have to calculate the standard deviation. I'll give you 2 minutes time. Please solve till here and verify the answer. All of you. I want standard deviation of Y and standard deviation of Z. Yes?
Yes, sir. Answer is correct.
Ranjit? Who
Yes,
told
sir.
you?
Sam, Steven, sir.
Okay, okay. Steven?
Yes, sir. Yes, sir.
What is this 0.2, 0.5 and 0.2? Can you tell me what are they?
So those are probabilities.
Why I'm multiplying with this?
Sir?
What you told, probability, right?
Yes, sir.
Perfect. See, 0.2, 0.6 and 0.2. Perfect, Steven.
Yeah.
Now the B part. All of you are done? So shall I go for the B part? Okay. Yes, Y security is comparatively riskless, since the variance and standard deviation are less in security Z. And the C part is concerned, so that is
Sir, here 0.5 we have taken, sir.
if the financial analyst wishes to invest half in Z and another half in Y, so what would it reduce the risk? Explain the reason for it. So for that, what I have to do, I need to calculate sigma p square, that is x1 square into sigma 1 square plus x2 square into sigma 2 square plus x1 x2 r12 sigma 1 sigma 2 a plus b whole square. Okay. So for the calculation of portfolio risk, what I have to calculate first, I need to calculate the correlation coefficient. How do I calculate the correlation coefficient? Covariance of YZ divided by standard deviation of 1 into standard deviation of 2. But we have to first calculate the numerator, right? All of you. That is covariance of YZ. See, how do I calculate covariance of YZ? It is summation of I is equal to 1 to n. Probability is there. Probability multiplied by y minus y bar into z minus z bar. Now what I'll do, 22 minus 12 into 5 minus 15 into the probability is how much? 0.2 plus 14 minus 12 into 15 minus 15 into probability is 0.6. This entire part will become 0, students, because plus 15 and minus 15 is there. Okay, it is 0 plus minus 4 into minus 12 into 15 minus 25 into 0.2. So how much it is? 22 minus 12. Please solve. I'll also solve here. 22 minus 12 into 5 minus 15 into 0.2. That is equal to minus 20. Perfect. Now the second part here, this one is 0 because plus 15 and minus 15, 0 multiplied by anything is 0. I'll go for the calculation of this part. Minus 4 minus 12 into 15 minus 25 multiplied by 0.2, which is equal to 32. So minus 20 plus 32 is plus 12. Right? So what I got now, 12 is what? The covariance. The covariance that exists between the two securities, that is Y and Z. So R is what? Correlation coefficient is equal to 12 divided by 6.3 into 8.6. What is 6.3? The standard deviation of security 1 into standard deviation of security 2. So in the numerator you have covariance, and in the denominator you have the standard deviation of two securities. So how much it will be? One four.
0.2214.
Perfect, perfect. So what is the correlation coefficient that exists between the two securities? 0.2214. Okay. Now the values can be substituted directly in the formula. So what I'm trying to find here, I'm trying to find here the standard deviation of the portfolio. So what I'll do directly, students, please understand, sigma p, I can use the square root here only and solve, or sigma p square, that is variance of the portfolio. So Vishal, how much they have given me the proportion? See here. If the financial analyst wishes to invest half in Z and another half in Y, that means what do you understand by this? What is the proportion?
50% and
Sir, 50% each, sir. 0.5
Very
and
good.
1.5.
in Y.
Okay. Now, standard deviation or the variance of the portfolio is equal to 0.5 square into 40 plus 0.5 square into 73.6 plus 2 into 0.5, that is x1 into x2 into correlation coefficient R, that is 0.22 multiplied by standard deviation of security 1, 8.6 into standard deviation of security, that is second security, that is 6.3. All of you solve whether you get the same value. Let me also solve. Yes, what is the variance of the portfolio?
$5.86, sir.
5.86.
Yes, sir.
I asked you what is the variance of the portfolio? Variance. I did not ask you standard deviation. Variance, is it correct? 34.5 or 34.4?
34.35.
Okay, perfect.
34.35.
Anything 34 is absolutely correct. Okay. Someone told 34.35. Square root of answer, even though you will get 5.86 only. You can verify it. Square root of 34.4 is 5.86. Students, you are getting?
Yes, sir. 5.86.
Okay. Now, combining Y and Z securities reduces the risk. Why? You can see here the correlation coefficient is 0.22, which is nearly equal to the negative value, right? So the reason for the reduction of the risk is that the securities have lesser degree of positive correlation coefficient. So combining the Y and securities reduces the risk. So that is what is the conclusion. So they have asked me the three part in this problem. Determine the expected rate of return, variance and standard deviation, we have calculated. Then is Y comparatively riskless, we have calculated. Then if the financial analyst wishes to invest half in Z and another half in Y, what would it reduce the risk? Yes, it reduces the risk. So shall we stop the session here? Tomorrow we will take up the next problem. Any doubt in the problem what we have solved today? Out of all the problems, whatever we have solved, any doubt, please ask me. Students, are you with me? Any doubt?
No, sir. No doubt, sir.
But all of you should solve the problem, huh? Every day I'm sending you the link of the YouTube, YouTube link. So kindly ensure that you solve the problem in your IM notes on the same day. And whenever you are reporting to the college, I'll be first checking your IM notes. It should be up to date. Okay. Okay, students, thank you so much for your patience. I think someone has replied, sir, 34. Okay. Dharmendra Pal has replied 34.4. Okay, perfect. So I will end the session for the day. Tomorrow we'll continue with the remaining problems.